We had nothing but negative economic news coming out in the past few days. Japan kicked things off with their Nikkei index falling by more than 17% to levels not seen since the major economic crash there of 1987. That market started panicking and it started spreading, most notably to the markets in the US, where on Monday Dow Jones fell by 1,000 points. S&P 500 fell to levels not seen in the past 3 months. The volume of trading activity in gold increased dramatically, while at the same time the price decreased, which is normally an indication of extreme fear in the marketplace. The crypto market corrected itself, and the Canadian dollar at some point started trading at 71 cents against its American counterpart. So all in all, there was nothing but negativity coming out in the past few days. And with this as a backdrop, it would seem that today's release of the TRREB market report is the least significant of occurrences. But it's important for people that live and trade real estate in Toronto for at least a couple of reasons. It gives us an indication and a snapshot of where the market is at up until the end of July of this year, because this is the month that the latest report is covering. And it gives us an opportunity to look ahead and see if we can forecast as to where this market is going to go in the months to come. So this is precisely the topic of today's video. I'm going to be talking about the latest TRREB market report for July. We're going to start things off with the major economic indicators. On the first page of the report, for the real GDP growth, we are positive 1.7%, always pleasant to see that. Compared to July reading for the first quarter of 2023, we were at 3.1%. So it's a massive decrease since then. And one other thing that's conspicuously missing from the TRREB report is the GDP growth per capita. So if you look at those two numbers together, the picture is not going to be all that rosy. Toronto employment growth is 1.4%, which is better than national average. It's declined by 0.2% as of the last reading. Toronto unemployment rate is actually pretty horrific, 7.8%. The national average is substantially lower. Inflation has gone down, but it's the same as of the last reading. We were down from 2.9% to 2.7%, and the overnight rate has not changed. We're still at 4.5%. Now let's look at what's happening with sales and average price by major home type, and we'll start with the 416 area code year-over-year changes. So here we see in the detached homes, we have sold 16% more homes this July versus 2023. For semis, 1.8% improvement. For townhouses, 16.6%. They're doing better than any other category of a home, and condo apartments are in a negative, minus 1.3%. For 905, detached homes are not faring as well as the 416 ones. We are negative 0.3%. Semis are at 10.7%. Townhouses, 6.2% improvement, and condo apartments, again in negative territory, minus 0.4%. One thing that's very important to note is that even though the sales are up from last July, the volume of new listings and volume of active listings sitting on the market has increased quite a bit. We'll cover that in a second. Now, as far as the prices are concerned, detached homes is the only type of property within the 416 and 905 area code that is in the positive. So we are here in the black, plus 0.5%. Barely moved the needle, but still it's good to see that things are slightly higher than they were. Semis, minus 0.4%, townhouses, minus 0.9%, and condo apartments are again negative 0.5%. 905 for detached, minus 1%. For semis, minus 0.5%. For townhouses, minus 4.2%, and condos are doing pretty awfully at minus 5.7%. Now let's take a look at the year-over-year summary. Sales are up as compared to last July of 2023 by 3.3%. New listings, and this is what is looking pretty bad, 18.5% increase in new listings, and an eye-watering 55.4% for active listings. That's the increase from July of last year. This is not looking good at all. This is probably the highest level of inventory that we've seen over the past decade. And the level of sales that is up from last July is still considerably down as compared to levels of sales that we had over the last 10 years. So all in all, this is not looking too good. Average price has gone down by 0.9% from $116,000 to $1,106,000. Days on market for property to sell have also increased to 36 from 23, which was the number last year, and we up for this particular category by 56.5%. Let's move on to the third page of the report that's going to give us some more information about what's happening with the average price of a typical house. All right, there we go. Average price of a house, we already mentioned this, is at $1,106,000, which is 0.9% below of what we had in July of 2023. Median price is basically a straight line that's cutting right in the middle of all the homes that are selling above this price point and all the homes that are selling below this price point. We're at $950,000 for July of 24. Let's compare it to 2023. Okay, average price is at $1,106,000. We already talked about this number. It's minus 0.9% as compared to July of last year. Median price of a house is at $950,000. This is the line that cuts straight in the middle of all the homes that are selling above this price point and all the homes that are selling below this price point. So it cuts it in two equal halves. So last year for the median price we were at $974,000. This year we're at $950,000. So we went down. New listings this year 16,296. Last year 13,712. Next one is an interesting one. SNLR is sales to new listings ratio with 39.7%. Anything below 40% is considered to be buyer's territory. And buyers not only have a ton more options to look at given the current inventory levels, but on top of that, they can be very adventurous with their pricing when they're bidding for a particular property, because if the seller is not playing ball, they can always look at other options, and there's plenty of options out there. So 39.7% is the buyer's territory. Last year, we were at 51.5% for the same ratio, which means that we were in the balanced market. Anything between 40 and 60% is the balanced market. Active listings, 23,877 for this year. For last year, we were at 15,371, a substantial jump. And months of inventory is another indicator that we are in the buyer's territory. It takes 3.2 months to dissolve the inventory with the current level of activity. Last year, we were at 2.1, again, a balanced market for then. Average sales price versus the listing price. Across all property types on TRREB, we are at 99%, meaning that properties are selling 1% below the price that they're listed at. In other words, if you were to list a home at $500,000, this gives you an indication that you can reasonably expect to receive about $495,000 for the property. Last year, you would get above the ask. 102 was the SP over LP, sale price over listing price. Okay, so now we can take a look at what's happening in the market in Toronto, specifically neighborhood by neighborhood. All the TRREB territories are here. And we're looking at price comparisons year over year. Too bad that this report is not in the proper color, because had it been so, we would have seen that everything is in the red. It would have been a total bloodbath. Single family detached year over year. You see everything is in the negative. I'm going to help you visualize what's going on in the marketplace by drawing these straight arrows from top to bottom. Single family detached, or attached rather, also everything is in the negative. Townhouses. Well, as I'm drawing the line, I'm noticing that there is minus 20.49% decrease for the CO9 area, July over July. And as expected, apartments, condo apartments included in this category, are in the negative territory as well. So all in all, the market is not looking good. So that's the market report in brief for the month of July. I don't expect any major changes coming down the pike over the next few months. One of the reasons for that is that a lot of the sellers are holding off listing their property until the fall, and once they do, they will only be adding to the already high levels of inventory, which is extremely unlikely to dissolve in the month of August. We're not expecting any new interest rate changes or announcements, so the buyer activity will probably be fairly low key. So with that said, if you're a buyer, there's going to be plenty of options for you to consider in the next 30 to 40 days before the market sort of restarts after the Labor Day in September. And hopefully the marketplace activity will increase so we can dissolve some of the existing inventory between now and the end of the year. So that's about it, guys, and I'm looking forward to seeing you again next week. But although the next market report coverage will be coming out in the month of September, covering the month of August. See you then.